What if one of the most powerful investors in modern history has been quietly doing the opposite of what everyone else is telling you to do, and almost nobody is paying attention? No press conference, no panic headlines, just a slow, deliberate exit that could be saying more about the future than any market forecast you've heard this year. For decades, Bill Gates was the face of Microsoft stock. His wealth rose with it, and for a long time his name and that ticker symbol felt inseparable. But quietly, year after year, Gates has been selling. Not dumping in a crash, not reacting to fear, methodically reducing his exposure, transferring ownership, and moving tens of billions of dollars out of direct public equity concentration. By most reasonable estimates, nearly $90 billion worth of value has been shifted away from what once made him the richest man on earth. And that number alone should make you pause. This wasn't a sudden move. It didn't happen overnight. That's what makes it so interesting. Gates began stepping back from Microsoft stock years ago, long before the recent waves of volatility, tech layoffs, and AI hype cycles. He diversified into private investments, farmland, infrastructure, and large-scale philanthropic structures that operate very differently from public markets. On paper, it looks charitable, and a large part of it genuinely is. But charity doesn't explain the timing, the structure, or the consistency of the strategy. Here's the part most people miss. Gates didn't wait for a top. He didn't try to time a crash. He acted when optimism was high and confidence was everywhere. That's not how retail investors behave. That's how someone behaves when they understand risk on a level most people never will. When your wealth is deeply concentrated in a single system, the smartest move is not to predict the next quarter, but to quietly reduce dependency on that system altogether. Think about what this says beneath the surface. This is not a bet against innovation. It's not even a bet against technology. It's a bet against concentration, against fragility. It's the idea that what worked for the last 30 years will automatically work for the next 30. And if that's the mindset of someone with access to the best data, advisors, and long-term models in the world, it raises an uncomfortable question about what the rest of the market might be ignoring, because signals like this are never loud. They don't trend on social media, they don't come with breaking news banners, they move slowly, quietly, and only make sense in hindsight. And by the time everyone agrees on what they meant, it's usually too late to act. That's why this matters. That's why this deserves more attention. And that's why what comes next is something you'll want to watch, how this pattern fits into a much bigger picture. Gates didn't just sell shares and park the cash. That would be lazy. Instead, the money flowed into assets that behave very differently from tech stocks. Farmland, utilities, private companies, hard assets with steady cash flow and low correlation to market hype. These are not the choices of someone chasing the next big upside. These are the choices of someone prioritizing durability over excitement. Farmland alone should raise eyebrows. Gates has become one of the largest private owners of agricultural land in the United States. That's not a trendy trade. It doesn't make headlines like AI startups or crypto. But it does one thing exceptionally well. It survives. No matter what happens in markets, people still eat. Water still matters. Energy still flows. These investments don't promise explosive growth, but they offer something far more valuable at extreme scale. Stability. Now zoom out. Over the same period Gates has been reducing exposure, public markets have become increasingly narrow. A handful of tech companies now drive a massive percentage of index returns. Valuations are stretched, expectations are perfect, and narratives are fragile. When markets rely on perfection, even small disappointments can cause outsized damage. Someone like Gates doesn't need to predict when that happens. He only needs to recognize that the margin for error is shrinking. There's also a structural shift most people overlook. When wealth moves into private structures and foundations, it exits the daily emotional cycle of public markets. No earnings calls, no algorithmic selling, no panic-driven volatility. Thank you, that's not just tax efficiency, that's insulation. It's stepping outside a system that has become faster, more leveraged, and more reactive than ever before. Ask yourself this. If you had tens of billions tied to assets priced on confidence, sentiment, and momentum, would you really want to stay fully exposed as uncertainty increases globally? Debt levels are rising. Geopolitics are unstable. Monetary policy has lost its predictability. None of this guarantees a crash, but it does change the risk equation. Gates's actions suggest he sees a future where preservation matters more than participation, where being slightly late to upside is acceptable if it means avoiding catastrophic downside. And that idea, more than any headline, should make investors uncomfortable enough to stop and rethink what they assume is safe in the years ahead. Because the most important insight here isn't that Bill Gates sold stock. It's that he changed how he defines risk. Most investors think risk means volatility, prices going up and down, red candles, headlines. But for people operating at Gates's level, risk is structural. It's dependency. It's being locked into one outcome, one system, one assumption about how the world should work. And that's where the signal becomes impossible to ignore. Gates isn't positioning for a crash tomorrow. He's positioning for a world that looks different from the one that created his fortune. A world where growth is harder, margins are thinner, and shocks come from places models can't fully capture: climate stress, supply chain fragility, political fragmentation, demographics. These aren't day trading variables. They're slow pressures that reshape economies over decades. When someone like Gates reallocates capital, he's not reacting to fear. He's responding to probability. He's asking what assets still function when systems are stressed, what holds value when confidence wavers, what produces utility regardless of narratives. And when you look at his moves through that lens, the message becomes clear. The future may still reward innovation, but it will punish overexposure. This doesn't mean the average investor should copy his portfolio. That's not the point. The point is awareness. Understanding that even the most successful beneficiaries of the modern market are quietly stepping back from its most crowded trades. They're reducing reliance on perpetual growth assumptions. They're preparing for a world where resilience beats acceleration. And that's the uncomfortable takeaway. While the public debates what's next, the smartest capital is already repositioning. Not loudly, not dramatically, but deliberately. Because the real signals never scream. They whisper. In the end, Bill Gates' silent sell-off isn't a warning of doom. It's a lesson in foresight. Wealth isn't just about knowing when to buy. It's about knowing when the game itself is changing. And those who recognize that early don't need to explain themselves. They simply move first. While everyone else is still arguing about whether anything has changed at all.